You're listening to Sound Money from Casey Research.
Hello and welcome to the Sound Money Show from Casey Research with me, your host, Andy Duncan. It's my great pleasure today to be speaking with Louis James, Senior Metals Analyst at Casey Research. Today we'll be talking about junior miners, stock evaluations, and the US tax loss season. Hello, Louis.
Hello, indeed.
Which part of the world are you in today?
Strangely enough, I happen to be home. Thanksgiving week even.
That's crazy. That can only happen 1 or 2 days a year.
That's right.
Now, stock markets in the US have generally been seeing tremendous growth over the last year or so, except perhaps mining stocks. The junior miners in particular have been beaten down quite badly. However, recently there appears to have been more interest in the junior miners. Can you explain what's going on here and why?
Well, I'd like to know who you've been hanging out with, because the interest is certainly not widespread. There is, I think, insider interest in the industry because of the awareness of the value to be had in the sector. But actually, my answer is not a deflection. This is actually a good thing. In terms of buying low and selling high, which is how you make money speculating, you need opportunities when there is a true market capitulation, when nobody wants to talk about something, hear about something, don't call me, I'll call you. Those are buy signals. Those are times when you can actually get a good price, particularly on a risky investment. You need that leverage from a very low entry point, and that's what we're seeing now. So, if you're seeing interest, you must be talking to very unusual people, because it's few and far between the people who are willing to buck the herd mentality and buy what nobody else wants.
Well, I think it's because I'm a natural contrarian as well, so I speak to a lot of contrarians. Now, you're a well-known exponent of Doug Casey's 8 Ps stock evaluation technique, which uses, if I'm right, people, property, paper, promotion, politics, push, price, and the slightly fudged one of financing, spelt with a PH rather than an F. Can you tell us what's the most important of the 8 Ps that you use, and how do you kind of leverage them?
Right. Well, the P's don't come in any particular order, but we do refer to people as the first P. And it's the one I absolutely start with before anything else. Whenever anybody suggests a company to look at, a broker, a reader, anybody at all, the very first thing I do is I look at management directors. And if there's any red flags there, I don't go any further, because it doesn't matter how great the rocks in the ground might be. The wrong people can sure mess them up. Unfortunately, there are some less than completely honest people in this business, and that's absolutely a landmine to be aware of.
What are your red flags?
Well, I have an extensive network in the industry built up over the last decade, and I also have the advantage of Doug's several decades of experience. So we have a lot of people that we know and know who knows and so on. And we can do our own background checks, as it were. But there's also the wonderful realities of the internet age, when anybody can Google. And one thing I would suggest to readers is, it sounds simple, it sounds obvious, but people don't think about it. Just Google management. And if there are 27 lawsuits on these guys, that'll tell you something. Take it with a grain of salt, because there are often disgruntled shareholders in our industry. But it is a beginning. And, from my perspective, if I know that somebody has been dishonest with me in the past, and this has happened, people will sometimes actually flat out lie to me in my face. Anybody like that, I don't care what the new deal is or how great it sounds, I'm not interested.
Okay. As well as gold and silver, on which you're an expert, what are your hot commodities at the moment?
It's interesting. In terms of commodities, we typically think of the base or industrial metals as being inversely market-oriented to the precious metals. In times of fear, gold and silver go up, and the industrial metals go down because there's economic uncertainty, and vice versa. But actually, since 2008, they've been moving together. So it's a very interesting commodities market, part of the larger sort of market kerfuffle of going off of sort of real economic business and reality of doing good, sound business to the federally stimulated economy and the sort of Alice in Wonderland rules that brings into play here. I'm not really answering your question, but what I am saying, though, is that perhaps instead of hot commodities, I have cool commodities. I'm very concerned about the industrial minerals, even though some of them have flavor of the day status these days. I do believe, as well as Doug, that the other economic shoe is going to drop, and there's bad news ahead for the global economy. And when that happens, the primarily industrial minerals are going to get whacked. There's just no other way around that. I do have one hot area in the metals markets right now, though, that's very interesting at this twist in our marketplace, and that is the platinum and palladium combination. The reason for that is that you have the patina of precious metals there, and as gold and silver rise, if Doug Casey and I are right about the economic turmoil ahead and the resume bull market for precious metals, this will bring platinum and palladium up again as well. But they're also industrial metals. They're used in catalytic converters and other industrial applications. And so if Doug and I are wrong and the stimulus packages of the various governments around the world get the new boom going again, then these metals take off that way too. So it's sort of a win-win proposition. But there's even a better reason to go along in this sector right now, and that is that most of the supply is in politically risky jurisdictions, particularly South Africa. And South Africa's been having strikes and power outages, just a world of hurt for the mining industry in South Africa. And that's where 70+% of the world's platinum palladium comes from. So between the supply potentials, the precious metal investment potentials on the upside, and the trouble in South Africa that seems likely ahead, this is a sector that has a lot of potential in the near and long term.
Does the same apply to rare earth minerals? Because I know a lot of those are in China, but there's quite a bit in South Africa as well.
Not really, because A, they don't have the precious side, where they're called rare earths, but they're not actually rare. And B, the constraints on that market are politically created. They're a result of policy on the part of China, not actual mine depletion or hard walls that you can't get around. Which makes it very risky. If the Chinese decide to change their mind about some of their policies, it could really rock those markets. There's also the fact that the rare earths were sort of the flavor of yesterday recently, and a lot of investors right now are moving away from that sector. They're disinterested. They've been burned by stocks that have gone down. So it'd take a really spectacular story to get people interested in that sector again, or in that pick again. So it's just a tougher road to hoe right now.
I've read a lot recently about Australian mining companies investing in particular parts of Africa. In your well-travelled opinion, what are the geographic hotspots around the world that should soon be attracting heavy levels of mining investment?
Well, certainly not Africa. And I say that with regret, because Africa is phenomenally endowed, and the people of Africa certainly could benefit from the jobs and wealth creation that spins off around mine sites in the world. They've got all the pieces, but of course, so many of those countries are kleptocratic, or the ones that aren't are unstable. So it's a tough place to do business. That said, generally speaking, West Africa is the better part of Africa, as far as I'm concerned. Ghana has been quite stable, and Mali and Burkina are in that same greenstone belt area. Good stuff there. Mali, of course, scared everybody recently with the coup in 2011. So Africa kind of scares people, but because of that, many Africa plays are discounted, and I'm not unwilling to go to Africa. But actually, the hot area, I think that maybe the next up-and-coming hot area is perhaps Scandinavia. You have very, very stable jurisdictions there. The governments may tweak taxes here or there, like everybody does, but they don't jerk the rug out of underneath businesses, even miners. And people don't often realize this, but there's actually a phenomenal mineral endowment across there, stretching from the gold and iron fields of Sweden across Finland and into northern Russia, where Norilsk has made all its billions in the nickel markets. So between Sweden and Finland in particular, I think you're looking at very low political risk, which is really something at a premium today. It's hard to find a jurisdiction where the politicians aren't trying to carve out another pound of miner flesh.
Now, I believe one of the oldest iron ore mining companies in the world is a Swedish one, which probably tells us something about the stability there. Now, I normally go into a coma whenever my accountant phones me. However, I believe in the US it's tax selling season, with people buying and selling stocks to fit within capital gains tax rules. Can you tell us what tax loss selling season means for markets and companies at the end of the year?
It's not uniform across jurisdictions, but with the U.S. being the gorilla in the China shop here, it's important to note that U.S. Taxpayers can sell stocks at a loss and offset gains in other sectors and other investments with those losses. They pay taxes on their net gains across their portfolio, not on the individual positions. So if they made a phenomenal amount of money on Apple, say this year, and they've got some mining stock losses, they can offset and pay less taxes on the gain in Apple by selling their mining stocks. And even if they still like those stocks, they may still sell them because they can sell them now, buy them back after 30 days in January. And if the market is still low, they can get them in at a pretty low price. And in other words, they essentially stay long, but at a lower cost basis, and they get a tax credit. This is an incentive for a lot of people to sell when a stock is selling less than it was a year ago around this time of year. And of course, with gold having retreated for the last 2 years, there are a lot of stocks that qualify for that.
Is there any particular area that people should be doing this in? Will it just be gold mining stocks, or will it broaden across various commodity mining stocks?
Now, I didn't say people should do this. Very disciplined investors can do this. But there is risk involved. If you sell in December or now and hope to buy back in again in January and the stock's gone up again, you may decide to wait until it comes back, and then it doesn't come back and it goes away. And then you will have bought high and sold low and really realize that loss. Yes, you got a tax credit, but you didn't get back in again on the upside you wanted in the stock. Or if it goes even lower, you may not have the courage to buy. You may ask yourself, where's the bottom? Is there ever going to be a bottom? It's very fraught with risk for people who don't have a lot of discipline and confidence in where the market is going to go.
Is the trick to give yourself a plan and to stick rigidly to that plan no matter what your psychology is telling you?
Pretty much. So, given the number of readers that we have and how few of them are really high net worth, super experienced, qualified investors, our general advice is not to actually take tax losses, but to take advantage of tax loss season. If you have a stock in a company you really like, and other people are selling it for tax benefits and pushing the price even lower, well, I mean, it's like your favorite steak at the supermarket going on sale. You buy more, you stock up the freezer when it goes on sale.
And are there any other areas outside of mining commodities that you've got your eye on at the moment?
Well, I should stress again, Doug Casey's mantra, if you will, that we like to speculate on the mining stocks, particularly the junior mining stocks, because they have volatility like no other stocks on earth. And to the upside, that can be just life-changing. But that is speculation. It is high risk. We like the metals themselves for prudence. If there is economic difficulty ahead, then having the wealth preservation safe haven value of gold, in not necessarily your mattress, but in hand, is very, very important. Broader than that, I would give a good nod to my brothers in arms over there at the Casey technology team. They have done phenomenally well the last couple of years, while gold has not done so well. So that's a good diversification strategy. And with global geopolitics being the way it is, I also would give a close look at what our brothers over on the Casey Energy team are doing.
And are you going anywhere interesting soon? Are you wrapping up warm for Scandinavia, or are you going somewhere a bit warmer?
Yeah, the Arctic Circle was my last trip. It was quite chilly. Well, actually, my very next trip is to the deserts of Nevada again, and then probably back to South America. It changes pretty suddenly depending on opportunities.
Okay, well, it's been great talking to you today, Louis. Where's the best place our listeners can discover more of your work?
There are prominent links on kcresearch.com. A good place to start for people who don't really know what we're doing is actually a totally free publication that we have in the Daily Dispatch. Every Monday, we put out a Metals and Mining Monday Dispatch, and we talk about various issues and opportunities in the industry. It's completely free sign up. If you like what you read, we can give you more specific advice in the paid newsletters.
Well, being a Yorkshireman, I'm very, very proud. I'm very happy to sign up for free things. So thank you very much for your time today, Louis James.
Thank you much.
You can subscribe to the Sound Money Show on iTunes or sign up to our podcast at Casey Research, where we'd also welcome your feedback. I'd like to thank our special guest today, Louis James, for taking the time to join us, and I'd like to thank you for listening to Sound Money Radio. If you enjoyed today's show, please let all your friends know all about us to help us grow this podcast. Meanwhile, and until next time, goodbye.